A credit card company underwriter shared years worth of advice and insights into how a large credit card issuer approves and denies applications and how they hand out large credit limits. People were able to ask as many questions as they wanted, and I included all 40 answers in this video, including 3 persuasive lines you can use with customer service to convince them to increase your credit limit, the 8 criteria they look for when deciding whether to approve or deny your applications, the highest credit limit they personally have the authority to approve for you, and why they never look at your FICO score or verify your income when making a credit decision. Let's start with the underwriting process. This is the first question. What percentage of applications are decided by an algorithm and what are done manually? The underwriter says around 80% of applications are decided by the software. The next question is, for applications that are reviewed manually, how subjective is the underwriting? The answer is 75% of the time when we underwrite manually, the decision is clear and there's almost no subjectivity. For the rest, there could be some subjectivity. I'd say maybe only 5% are truly on the fence applications. So if 80% of applications are decided by software and 75% of manual underwriting isn't subjective, that leaves about 5% of all applications that involve real subjectivity. By the way, a manual review doesn't mean the application falls into some sort of gray area. For example, if you have a strong credit report, you should be instantly approved. But if you're also asking for a balance transfer at origination, we might opt for a manual review to see if we can approve you for a credit limit that accommodates that transfer. And another one of the many reasons for a manual review is your credit report is awesome, but you stated an unusually low income, which means we can only approve you for a low credit limit. We might probe you for additional income. You know, I just want to say here that I think a lot of us have this idea that these bankers are all applying real skill and making tough decisions about us when we apply. But in reality, these are just employees that work within a highly controlled and procedural system to make most of the decisions for them. The preset algorithm is calling most of the shots 95% of the time here. And the next question is, how can you see my bankruptcy since it's been 7 years? You aren't allowed to consider it because it should have dropped off. And the underwriter says, for some reason, old bankruptcies can still appear on your credit report. You'll need to take it up with the credit bureaus. Even if a bankruptcy is over 7 years ago, if we see it, it'll be considered. Now, I would say here is where it's important to scan your credit report at least once a year for mistakes like this. You can use one of my credit agency letter templates to get any of those mistakes removed. I'll leave a link to that below. So the next question is, what if your analyst doesn't like me personally and decline my application? Now here the underwriter said, as mentioned earlier, very few of our decisions contain any real subjectivity and the majority are done by software. But in the rare cases where it's a manual process and your credit history falls in a gray zone, it's surely possible that an analyst who got offended might decline you. That's why I suggest treating your phone call as if you're applying for a job and be as professional as possible. And sorry, there's just no way to remove the human element. Our work is performance evaluated by the company based on 3 criteria. How fast we work an application, how politely we speak on the phone, and how accurately we make underwriting decisions. Because calls are randomly pulled for evaluation, it's unlikely the analyst will be rude just to spite you. Now here's what I think. It looks like making a human mad is the least of your worries. Your real enemy is the AI bot scanning your credit report with cold precision. So the next question is, if an applicant puts retired or unemployed as their employment status, curious to your thoughts if it's an automatic denial or not. They go on to say it's not an automatic denial if the applicant has retirement income like investments or a pension. Even younger unemployed people can have income such as collecting disability or getting student loans. Still, I don't see why anyone who is younger should admit he's unemployed when applying for a credit card. That's just being way too honest. So I would say, even though these questions do work on the honor system on the applications, I'm still surprised they're so relaxed about telling a small lie here. I guess the bank is content just making a decision based on your past payment history. If you're unemployed but still making on-time payments in full, then you definitely have some income. Now here's a big question. How do you know if the income I gave is accurate? And he says, we don't. We know stated income is usually exaggerated, but your credit report can suggest whether your stated income is believable. Whether we believe it might influence our underwriting decision though. For example, if you claim to make $250,000 per year, but just took out a tiny auto loan for $14,000 over a 7-year term, that'll make us question your stated income. Our underwriting notes on your file might read something like $250K year income versus $14K 7-year auto loan, decline. Now, since our notes can be legally subpoenaed, we'll never write applicant is lying, but anyone at the bank reading this note will know what's being implied. There are other negative information on your credit report that could make us question your high stated income, such as lates or persistent high credit card balances. By the way, income rarely determines whether the application will be approved. It's more used to determine the credit limit. Now, I'd like to add something to the answer there. Low income could cause denials with cards that have higher than average minimum credit limits. Most typical cards have a minimum limit of $500, but some cards out there start at $10,000, like the Chase Sapphire Reserve card. Did you know that many cards don't verify your business income either? For example, I just signed up for the Chase Inc. Business Unlimited card, and they approved me for a $21,000 starting limit. You can type in whatever your annual business revenue is, and obviously you want to be as accurate as possible, but there's no other documents needed here. Plus, you can apply as a sole proprietor, so you don't need to form an LLC either. Right now, it has an all-time high $900 sign-up bonus and 0% interest for the first 12 months. You can hit the link below to learn how to apply for the Chase Inc. Business Unlimited card. So the next question is, I need details. Can you give specifics on how you assess someone's credit report in making a decision? So he answers by saying, there is so much, it's impossible for me to give specifics. After working there for a few months, the credit analyst will develop a sixth sense for how the bank wants us to lend. Our decisions are randomly reviewed by managers when our job performance is evaluated. Based on those reviews, we become increasingly calibrated and develop a sixth sense. The only thing I'll say is we're trained to weight the positives and negatives of your credit report and determine which side is more compelling. The positives are on-time payments, payments in full, long trade lines, high usage of the card, few hard inquiries, paid off mortgages, and auto loans. No bankruptcies and no charge-offs. The negatives are the opposite. There's really no big secrets or surprises here. Next, is there a racial or gender discrimination in your underwriting? And they say absolutely not. We don't know this information, nor will we ask you. However, there is age discrimination. When we encounter a credit report with few activity, age can be a deciding factor. For example, for a young adult, we can understand if there's little credit history, but if you're in your mid-50s and have little credit history, it would suggest a bankruptcy. Now, even if the bankruptcy has dropped off the credit report, there'll still be a huge black hole during which no one was lending to you. That's why someone in his mid-50s with little credit history would be concerning. This is the modern world where it's difficult to live without a credit card for an extended duration. Now, I would say even though they don't know your race, I'm sure they could make an educated guess based on your zip code. But it's nice to hear that they strongly rejected the idea of discriminating by race. Now, here's the next question. How do you weight profitability versus creditworthiness? Could someone with an excellent credit file but many open cards be declined simply because they appear not to put much on any of them, and thus generate low swipe revenue and a low likelihood of interest payments? So they answered by saying, one time during our monthly floor meetings, a vice president said something interesting. He said our most profitable accounts are those that are slightly above subprime. Although we're not a FICO lender, that'd be the equivalent of a FICO in the low to mid 600s. He said these folks tend to revolve balances, pay lots of interest, pay fees, including the annual fee, and also buy subscriptions such as credit monitoring. Subprime lending is massively profitable, and the abuses it caused was the reason why Congress passed the Credit Card Act back in '09. But when it comes to underwriting, we don't take profitability into consideration. It's possible our marketing and finance department would take profitability into consideration when deciding to pre-approve someone. Now, here's what I would say. What we're starting to see here is these underwriters actually have very little say in who gets approved and very little understanding about how the whole operation works. You notice how before it was the automated algorithm making decisions, and now other departments are responsible for other decisions that you think will be included in the underwriter's scope of work, but it's not. Now, here's the next question. You lowered my credit limit or canceled my account because I defaulted on another company's credit card. Is this legal? And they're going to say, yes, this is what we call a universal default. If you manage your credit card account poorly elsewhere, we might question if we can continue our relationship with you. Now, bear in mind, when we open your account, it's based on your credit worthiness at that time. If that worthiness decreases significantly, that means you risk no longer qualifying for our card in the first place. Next question is, I thought the Credit Card Act of '09 made universal defaults illegal. And they answer by saying, in the industry, the term universal default refers to the credit card company jacking up the interest rate if you default on another company's card. That practice was indeed made illegal. However, we also use the term universal default internally when referring to any negative action we take based on a customer's other trade lines. So if we shut down an account, if he defaulted on another company's card, we call that universal default. This term is used only in-house. We'll never use jargon like this when talking to customers. So here's what I think. I know a few banks that have a quick trigger when it comes to shutting down accounts, like Synchrony and Comenity Bank. Lenders are always taking notes about your relationship with other lenders. It's really good to see someone in the industry openly admit to this. So here's the next question. Does the underwriting process notice I'm only getting the card for the 5% category, obvious from the cards I already have, and will cost the credit card company money? Or do they focus only on credit worthiness? And they answer by saying, if you open and close, similar to card churning, it'll have an underwriting impact. But if you open just to use the 5% cash back, that's a legit use of the card and won't be viewed negatively from an underwriting standpoint. As for not making money, the credit card companies earn a fee from the merchant at the point of sale. Furthermore, although I don't have details, I'm sure the credit card companies also get paid by the merchant as part of the merchant's marketing. It wouldn't be a surprise to me if Amazon or Walmart pays Bank X, for example, a huge fee to be part of a 5% promo. The great thing for consumers when it comes to credit cards is that most of your convenience is paid by the merchant. Now, here's what I think in this instance. Right now, they're talking about interchange fees where merchants pay the bank and payment processors between 1% to 3% of every transaction. I find it interesting that they don't use technical terms here. These employees are not credit card enthusiasts like you and me. They don't study credit building techniques. They mainly know the specifics of what it takes to underwrite credit cards quickly and accurately. Don't expect them to understand your strategies or credit card goals. So here's the next question. Hard pulls only have a small impact on your credit score though. So how much of an impact does churning really have on an application, assuming someone has a high score? So here's how they answer. Whether there's an impact on your underwriting depends on whether those accounts create a bunch of hard inquiries. FICO might not think they're a big deal, but we will if it's excessive. Another thing to consider is churning leaves a lasting impact on your credit report. It creates a lot of trade lines and gives the impression of financial stress, even if the inquiries have fallen off. You might be able to explain it to a credit analyst that they're just for benefits, but in this world of increasing automation, you might not have the luxury of explaining yourself when the decision is made by software. Now, my thoughts on this are you need more than just a great FICO score. You need a great all-around credit profile too, because every lender will interpret your FICO score and credit report differently. This is why some people complain about not getting approved for basic cards when they have a credit score over 800. Here's the next question. Are you telling me that your financial institution doesn't use Equifax, the work number, to verify income? They say that's correct. We're underwriters at a credit card company, not HR doing employee background checks. When credit analysts are asked to make between 12 and 14 underwriting decisions per hour and also be on phone duty, they don't have time to call Equifax's work number. Besides, your income is not even close to being as important as your credit history. How many rich people are terrible with their finances? I have a few thoughts on this. That means they have to make a credit decision every 4 to 5 minutes. That's lightning fast. These companies are not treating you like an individual and considering your whole life history. They're making cold, formula-driven decisions at high speeds with brief moments of human intervention. Next question is, wouldn't a W-2 or 1099 request clear up that pretty easily without having to make a potentially incorrect assumption? Or is that just not worth the effort? They answer by saying, I think many people would be surprised how little time we spend on someone's application, whether it's underwritten by software or manually. There's no time to do income checks, especially when income plays an extremely small part in the approval process. And even so, I have a feeling that credit card companies feel your income can be inferred by what's in your credit report. Now, here's what I think. It really seems like people strongly want their incomes to be verified. Here's what you gotta remember. Credit card companies can adjust your credit limit at a moment's notice, or even shut you down for hardly any reason. Having that power lowers their risk of lending you too much money, I would assume. And let me give you this example. When I moved to North Carolina, I made a large transaction on my X1 card, and they locked my card from making new transaction until I paid that charge off. It's just a reminder that your credit limit is not set in stone. They can shift it up and down at will. Here's the next question. Just to confirm, assume I have a half dozen cards with maybe a 15-year average age. What would you infer if every account had a maximum usage of $0 or some small percentage of the line? And they answer by saying, in your scenario, the latter would produce a more positive result if you applied for our card. Even if your cards are 15 years old, if you've barely used them, it does us no good when we evaluate your credit worthiness. Sure, it proves you don't need credit, but it doesn't show how you manage credit. Borrowing money in and of itself is not a bad thing, Most of us have to do it at one time or another. Most businesses, even very successful ones, have to occasionally borrow money. The way you manage and repay that loan is what allows banks to evaluate your creditworthiness. Now, next question, how do you treat people with very recent hard pulls? For example, same day or same week, same month. And they answer by saying, for us, hard inquiries are hard inquiries. It'll be considered the same whether it was pulled last week or 4 months ago. Now, I think this is just another example of how your FICO score could tell you that you're good, but the credit card company could still reject you. Your credit report can give you a decent idea of your creditworthiness, but the lender has the ultimate say. The next question is, when making the approval or denial decision or for credit limit, if the applicant has savings and investment accounts with a good amount of assets, cash and stocks, for example, at your financial institution, does that help with the credit card application? And here's where they said for underwriting decisions that are done by software, your pre-existing relationship does factor in. But when I do it manually, I never pull up someone's investment or checking accounts, even if they're held with us in another division. We don't even have a system to do that. We probably should though. And he says, I have a friend in the Philippines and he says pre-existing accounts is the primary way of getting a credit card account with them. They don't have the kinds of credit bureaus and detailed credit reporting we have though. So I'd say to this, you would think that the relationship you've built with a bank would be managed by an actual human, but that seems to be outsourced to the AI. Next question is, how often do you guys give automatic credit limit increases? And they said there is no timetable. Using the card actively and paying in full is the likeliest way of getting one. Credit line increases might also be given based on the company's financial condition or on the country's macroeconomic situation. So here's what I think. The rule of thumb is every 6 months, but I've seen banks like Discover and Goldman Sachs giving increases as fast as 30 days. I'd say you really have to test the waters for yourself to find out. Here's the next question. You decreased my credit limit and it screwed up my FICO. Can you reverse that decision? And they answer by saying, unfortunately, we cannot. Credit card accounts are an unsecured loan and the bank has full discretion on the amount to lend or whether to lend at all. And I think this is telling me those reconsideration phone lines that used to work for so many are increasingly less effective. All right, next question. Does paying multiple times a month, aka called micromanaging, create flags for your fraud department? And they answer by saying, working in the credit department, I'm not sure if multiple payments in the same statement cycle would trigger a fraud alert. But from an underwriting standpoint, this has no bearing on what we deem is your credit worthiness. When customers ask for a credit limit increase, I don't even look at a customer's statement that closely to see multiple payments. Making multiple payments and maximizing your card usage is a legitimate way to rack up points. Credit card companies should love this, as this also maximizes the fees it collects from merchants. Now, I'd say this is good to hear since some credit cards will give you a super low starting limit that forces you to pay down the balance multiple times a month just to use the card for your normal purchases. This happened to me when US Bank gave me like a $500 limit on their Cash Plus card initially. I had to wait 6 months for a decent limit. Next question is, how do other lenders on the credit report bias you? If you see a subprime lender, are you likely to mimic? Are there subprime lenders that might be red flags to make you rethink an application otherwise likely to be approved? And here's what they said. It has no impact on us. If your income is believable and your credit report contains almost no negatives, our credit limit will come somewhat close to what other banks are giving you. It doesn't matter if they're known for subprime lending. Many applicants start off with a subprime card and build it up through a decade of responsible usage. It seems unfair their record should be tarnished just because the card started out as a subprime product. And I've said this for a long time. The credit card companies are literally copying each other when it comes to shutting down accounts and with the amount of credit they lend. This is why it's so important to continuously raise your credit limits because it affects any new credit cards you sign up for. You should know I released all of this information in the Credit Connect newsletter like a week ago. So if you want to be the first to get info like this, you can join over 6,000 other credit card enthusiasts by hitting one of the links below and downloading any of my free credit card cheat sheets. Now let's get into what the underwriter thinks is the ideal candidate or applicant for approval. Now this is important. The first question is, what can I say to improve my odds of getting a credit limit increase? And here's what they said. When we ask why you're seeking a higher credit line, don't say anything that suggests financial stress. For example, I need to pay the electricity bill, I need to buy new tires for my car, or I need a cash advance. This means avoid giving any sort of sob story. Instead, talk about life events. These are moments when even financially secure people need more spending power. For example, my daughter is getting married, or we're prepping to sell our house, or even my wife is expecting. You know, when I saw this, I said, this is one of the best credit card hacks I've seen in a while. You could even try adding to these to sell it more and say something like, my wife is expecting and we're remodeling a bedroom for our new baby. And something else I need to mention, Capital One's online credit limit increase application asks a question just like this. So now you know exactly how to answer it. Just pick, I expect higher expenses over the next few months. All right, the next question is, if my application gets declined, how long should I wait to reapply? Now here's what they said, we're strictly forbidden to quote a time frame as not to imply a promise. Furthermore, our lending standards can change. Our CAN response is the longer you show a good credit history, the likelier you should see an approval. But if I were to advise you off the record, I'd say 12 months. During this duration, make sure you're not late on any trade lines and pay them down as much as you can. If you reapply sooner, frequent hard inquiries will hurt your chances. Now, let me say this, you definitely do not need to wait this long. You should only need to wait 3 to 6 months before applying again for a decent chance of approval, depending on the reason you were denied. If it was due to too many hard inquiries, then of course you should wait longer for those inquiries to fall off after 24 months. All right, here's the next question. What FICO score are you looking for? And they go on to say, we're not a FICO lender and don't go by those scores. FICO factors in things we don't care about. For example, when looking at your credit report, we're not allowed to consider medical collections and utility collections. We feel these types of derogatory information, which lowers your FICO score, are unreliable. So I'd say most credit card companies will at least give you a ballpark range of where your FICO score needs to be to get approved. For example, good or excellent credit. Some of these new fintechs go a step further and give your exact cutoff scores like the Apple Card did with their minimum score of 600. The next question is, on my credit cards, do you like to see revolve balances or should I pay off the balances every month? Here's what they said. It's understandable to think credit card companies prefer you revolve your balances to collect more interest, but for underwriting, we definitely like to see payments in full. One of the things we look for are large paydowns. For each trade line, your credit report states what was its highest balance and the current balance is. So if you had a credit card with us or elsewhere and paid off a $20,000 balance without transferring it to another card, we'll view that positively. If we ask why your balance is consistently high on another card, you can say it's on a 0% APR. That might mitigate some of our concerns. We have no way of knowing what APR you're paying elsewhere. Now here's what I think. They just gave us a real pro tip for a good excuse to give the rep if they determine one of your credit card balances is too high. Just say you're taking advantage of a 0% APR intro bonus period. Next question is, what debt to income ratio are you looking for? And they say, we don't use any mathematical formula. Like I mentioned earlier, income is rarely used in deciding whether to approve. It's used mostly to determine the credit limit. If we can never know the applicant's income, it seems pointless to look at any debt to income ratios. Now, this is where I would say it's surprising because it's common knowledge that you never want to keep your debt to income ratio too high. This may turn out to be an issuer-specific rule though. But as stated previously in the underwriting process, they strongly consider your payment history and look for large paydowns on other credit lines. They even stated that they prefer to see statements paid in full from month to month. Doing that would almost guarantee that your debt to income ratio was pretty low. Now, the next question is, if I'm on the phone and don't like your credit decision, would escalating to a manager make a difference? And they said probably not. Like I mentioned earlier, the amount of subjectivity in the underwriting process is low, but it doesn't hurt to escalate if you have time. If you're on the phone with us and escalate, we'll tell you that a manager is unavailable and you'll be placed in a log for a manager to call you back. And that's a lie. There's almost certainly one there, and that manager can take the call immediately if he or she wanted to, but we just use the call log to deter you from escalating. Still, we will absolutely call you back. Now here's what I think. They really shouldn't be able to lie to customers like that, but I have a question for you. If the rep told you that there was no manager available, would you give up? So here's the next question. Will putting my son on as an authorized user on my card boost his chances of getting an account with you? And they said no. There are lots of credit counseling advice that says listing your young son as an authorized user will help him establish credit. Since I don't work for FICO, I don't know if this improves your FICO score. But like I mentioned earlier, we don't lend based on FICO scores. Let's say person A has an account and puts person B on as an authorized user. This doesn't make it likelier for person B to get his own account with us. Person B has no legal responsibility for paying person A's account, and therefore we don't deem that information relevant. Now, here's what I'm thinking. This is probably one of those scenarios where the computer may take an authorized user relationship into account since the human underwriters don't have enough time to consider too many variables. But it's very telling that they have no idea about general strategies to improve your FICO score, even though they handle credit reports on a daily basis. Their focus couldn't be more narrow. So the next question is, I've had late payments and cannot pay down my balances. How can I game the system and still get approved? The underwriter said, I don't see a way to do that. The vast majority of the time, the credit report is the only tool used to make a decision, and most of it is done by software. I would contact your lenders to see if they can remove some of your lates. I'd also ask family members for a loan to pay down some of your balances. Lastly, check if there's anything on your credit report that can be disputed. Hey, you guys, if you haven't yet, go ahead and take advantage of my free credit repair course. I'll leave a link to that below. Again, it has everything you need to dispute fraudulent late payments and negotiate a debt settlement with a lender. Now, personally, I would take the Dave Ramsey approach and just aggressively pay down all my debts by myself. All right, so the next question is, if I have a bunch of unused credit cards, do you prefer to see them closed? They went on to say, from an underwriting standpoint, there's no reason to close unused accounts, especially if you've had them for a long time. We like to see accounts with long tenures. There is a risk that a bank can close an account due to non-usage though, so it might be worth using an unused card from time to time. So here, they forgot to say in addition to accounts with a long tenure, they like to see accounts with usage and large paydowns of the statement balance each month. All right, so the next question is, I love to open a credit card account just for the opening benefits. Then I close them. Does this hurt my chances you'll approve me in the future? And the underwriter said, we call this card churning. This is not a good idea because you'll be racking up hard inquiries on your credit report. Like I mentioned earlier, we also prefer to see accounts with a long tenure. Now, here I say banks see churning as one of the worst things you can do outside of not paying your bill on time. All right, the next question is, can I call and ask for a 0% APR period for a card I've had multiple years? I randomly have been given this in the past, which is why I ask. And they responded by saying, our jobs as underwriters never deal with lowering an APR. I will refer you to our customer service department. And before working as a credit analyst, I worked as a frontline customer service rep for another credit card company. When customers ask for lower APRs, or what we call a reprice, we click a single button to see if they get one. It's totally done by software. Nothing you say to us would affect the outcome. I would listen to your story, empathize with it, and then click the button. Now, the good news is there's no hard pulls on your credit report. There's no downside in asking for a lower rate. Now, I would say it seems like to some extent, they're glorified button pushers because in a lot of instances, they're a human front to get randomized decisions from the all-knowing computer. So the next question is, if I use Amex like a bank card, meaning I charge all my daily expenses, gas, food, anything cash users use cash for, and anything people are afraid to use credit cards for, use bank cards for, and pay it monthly like a responsible user should. How good does this make me look in addition to keeping revolving usage on other cards total of 2 to 3%? So they went on to answer by saying different banks lend differently, but with us, we aren't holding usage to a formula. We want to see payments in full. If you revolve a small amount but otherwise pay on time, it wouldn't be deemed negatively. It'll only look better if you pay in full. I'll only say if you keep revolving at 2 to 3%, why not just pay it off? So here's what I think. This bank would prefer you pay in full and not pay any interest than to revolve a balance. This kind of contradicts what they stated in a previous answer. If you noticed before, they said earlier that their most profitable accounts are slightly above subprime and the accounts where they pay interest. Now, you would think that the bank would always want to bias towards making more profit, but I definitely could see a scenario where too much profit in one risky area, like outstanding debt, could lead to long-term losses. Either way, I'd say it's best for most people to simply pay in full each month. And now the next question is, how important is having a good credit mix to your underwriting team? And they responded by saying, for us, having a mix isn't important. Let's say you have 3 different cars that you've had for 10 years. All actively used, mostly paid in full every month, and no lates. We wouldn't care if you never took out an auto loan or a mortgage. Now, here's what I think. This seems to be bank specific and lending type specific because I know of other lenders in the business space who look favorably at people who have a mortgage reporting on their credit file. So I just want to tell you guys what they said about churning. They said churning has been going on for a long time. In the pre-internet age, applicants applied just to get a free sports bottle. But they said a friend of theirs had excellent credit and a high income and got denied for a basic card. And it seemed like that bank labeled them as a churner. Another thing to remember is banks won't always tell you the real reason for decline. The applicant will just have to find out the hard way if he keeps getting denied. Now, I got a few thoughts on this. From what I've learned, banks by law do have to give you a reason for why you were denied, but they don't necessarily need to give you the actual reason. Plenty of us have been given confusing and obviously inaccurate reasons for denial. So the next question is, how do I get a job as a credit analyst? Should I go to school for business? They said for my position, they only require a college degree with any major. I had the extra benefit of working as a customer service rep at another credit card company though. And you don't need any special skills to be a credit analyst where I work. There's only basic math involved. Now, here's my opinion. This should really tell you that there's no expertise being applied here. It's a fine-tuned computer algorithm backed up by a random college graduate. Most of this job has been turned into a standard operating procedure and automated away. And the underwriter went on to say it was jaw-dropping to see how many indebted Americans there are. You have people earning solid six figures who are paycheck to paycheck and revolving their balances. They said, I don't have the numbers to prove it, but I wouldn't be surprised if the revolvers outnumbered the transactors by 3 to 1. And I would say if this is true, that would mean the 50% figure floating around the internet is completely wrong and instead should be closer to 75% of credit card users are actually revolvers. And that's not surprising because a study done by the Bank of Boston says the average value of a cash transaction was $22 compared with $112 for credit card transactions. Banks don't want you to know that you spend way more money when you use credit, and you can find 14 more secrets credit card companies don't want you to know right in the next video. Thank you for watching.